A lot Bitcoin's already had a lot of powerful price action, obviously, earlier this year. So I think now it's consolidating a little bit, but over this year and next year, I'm bullish on all those assets that I mentioned. And of course, it depends on what their capital mandate is. So, energy is cheap and profitable and has good balance sheets generally. Gold and Bitcoin are kind of alternatives to treasury bonds or alternatives to tech stocks, for example. They can fit in a portfolio in that context. And so those are kind of the assets that I find attractive at the current time.
Would you say that valuations are a concern for you at current levels for all of these assets?
So I think that large cap growth equities have valuation concerns. So, for example, large profitable tech companies, even companies like Costco, for example, they're very highly priced relative to their fundamentals, relative to their growth. Basically, it's not a problem necessarily with the companies themselves. I mean, Costco is doing amazing. It's just that investors are really crowded and really kind of piling into them. So, I do have valuation concerns for those. I don't really have valuation concerns for energy, for certain ends of the value spectrum, for some of these smaller companies. That's the capital flight out of there, I think, has been indicative of risk off behavior. And so I don't view that the current period we've been in as super risk on. And instead, it's more indicative of fiscal dominance, indicative of how many other areas are perceived as non-investable. And I think what we could see is a broadening out of what is perceived as investable, right? So some of the risk sentiment could actually increase for some of the things that have been considered too risky, whereas some of those things that people crowded into, I think people could get quite concerned with the level of valuation there relative to the growth numbers that are coming in. If you've seen, for example, Apple and Tesla just not putting up amazing numbers, and the problem is that investors had overpaid for relatively spectacular results that they're not getting in the fundamental data.
Yeah, so sector specific, then, well, the obvious follow up question is which sectors are you most bullish on and least bullish on?
So I generally like industrials. I like energy. Energy, I think, is the more attractive risk reward. And I think with financials, as long as you kind of avoid the commercial real estate concentration, I think most of that is decent, or that I kind of put into the too hard pile and say that it's not a lot of opportunity for the amount of risk I take on.
So if you expect the yield curve to steepen, I'm assuming then you expect the long end of the curve to continue going up, even if the Fed cuts, which would bring down the short end of the curve. Is that correct?
Yeah, or it stays sideways while the Fed cuts the short end. There's a couple of different ways and magnitudes that could happen. And to the extent that long end yields stay higher than expected, that could put pressure on some of those highly valued equities that we just talked about, right? So I think the bond market's already a little worried about reaccelerating inflation, but we haven't really seen that in the large cap equities yet. I think that they've still discounted the possibility of reaccelerating inflation, and so some of that's potentially not priced in. And so those crowded areas might not, they might correct or at least stagnate for a period of time if they come to fully realize that the long end yields are maybe not going down as quickly as some investors expect.
Are we having reaccelerating inflation, Lynn? I mean, the latest CPI numbers have not fallen at all since the previous months. However, they haven't substantially reaccelerated, at least on paper yet. So please elaborate on what you mean by that.
So I think it's super high. It does slow down that private sector credit creation moderately, but then it completely blows out the public interest expense and overall fiscal deficits by an even larger number. And so they're not really able to slow it down to the extent that they would be able to if they were in a lower public debt environment and where most of this was coming from that private sector. So it's really about not having the right tools to address it directly. And I think that, they've been kind of been acknowledging that, even just not directly. So I think what you would generally see is they'd probably stick at relatively high interest rate levels. They probably would not aggressively raise them more. They might focus more on curve steepening because that's a way to, moderate cost for the government, while keeping higher interest rate pressures on the private sector, mortgage rates and corporate bond rates and things like that. So I do think that they might start targeting curve steepening. But I think it's mostly about just expectation management. I think they're going to be relatively neutral, even if inflation reaccelerates. And I think it's going to be an ongoing kind of narrative issue for them.
Suppose energy moves up and accelerates there and brings inflation up with it.
To rise public debts and deficits, but your interest rates go all the way to zero and bounce off zero and then start going sideways to up, you no longer have that offset anymore. And so I think that's the bigger factor for what's happening is that the kind of the natural conclusion of decades of deficits and debt accumulation is that we kind of enter this new period where interest expense starts to actually matter and they start to enter this kind of long-term fiscal spiral, which again doesn't mean anything major happens this year, but it means that this overall kind of fiscal train is not going to stop anytime soon. And it's this new background structure that as investors or any of us operating the economy have to contend with, that it's a different background structure than the prior decade.
I've noticed just by looking at the chart that the federal surplus or deficit, in this case the deficit as a percentage of GDP, has continuously widened over the last 40 years.
Deflationary offsets from things like AI or other tech. So, for example, if you ran very, very large deficits, but those, for example, if you ran very large deficits, but you used it to, go get copper mines and build nuclear plants and data centers and things that were highly productive, it might or may not be as effective as the private sector, but at least you'd bring new supply online at the same time as you're debasing your currency, so you can minimize how much on a kind of a per currency basis these things are getting more expensive, if at all. The problem comes in when you run this big fiscal deficit, but it doesn't go toward increasing the supply of goods and services. It goes more toward consumption or more toward locked in demographics or towards war or things like that. They're not really kind of fueling that real GDP growth. And so it to the extent that AI or energy abundance helps keep CPI down, then and we've generally seen energy kind of oil prices and gasoline prices kind of bounced off their lows a couple times and headed up. I think my guess is that the lows are in. Maybe retest them again, but overall I think there's more upside potential than downside potential. But then the second part of the investment thesis is that even if energy prices don't go up as quickly as I think they will in the years ahead, and they're on the more bear side of a kind of like sideways trend, a lot of those companies are cheaply priced even for current energy prices and have good balance sheets and spend most of their capital on returning it to shareholders. So they kind of keep their current situation, but they're not aggressively trying to expand. And instead, they buy back shares, they pay dividends, they improve their balance sheet, they decrease their net debt. And so that's basically a it's something like an amount of energy that can power the Bitcoin network 8 times over, or how much methane leaks out from landfills into the atmosphere, right? So basically, there's a unfathomable amount of just stranded energy out there, and over time, Bitcoin kind of fills in those gaps. It takes a couple cycles to do so, but we've already been seeing it do that. And I think that trend's going to continue. I think it just becomes an embedded part of the grid. And then anytime you have any sort of variable power or fluctuating demand relative to steady power, you're leaving money on the table if you're not using some of that to mine Bitcoin. Because if you're getting zero or negative cost, negative revenue for your energy, then you're leaving money on the table.
On that note, let's finish up on the Bitcoin and gold price. First of all, do you think Bitcoin and gold moved up for more or less the same reason this year?
I generally think so. I think we've generally seen improving liquidity. A lot of it's fiscal driven, and so I do think that they've resisted the fact